Hello, this is Professor Hazara once again. Let me just very quickly check to see if the audio is working, and it seems to be working. So let's go ahead and continue with the third video number 3 out of 4 videos. Now, in the previous video, I had used the adjusted present value approach, so to speak, to calculate a share value for Lilly, assuming $11.66 per share. Okay, now I'm going to do the same thing using a different method, the weighted average cost of capital approach, and we're going to get the same answer. But the reason I'm teaching you 2 different methods is because depending on your objectives in evaluation, different methods, one method may have advantages over the other, or they complement each other. If you're doing, let's say, evaluation of a merger of some sort, which is leveraged, I would say the weighted average cost of capital approach would be very appropriate because there's a lot of debt involved. And it focuses, it's all about perspective in these cases. Okay, so let's start with weighted average cost of capital. Now, the thing that we haven't done so far, and I have to do it now, is I have to calculate, for the weighted average cost of capital approach, I have to calculate a variable that I haven't calculated up to now. And that's, I'm just going to say interest expense. I have to calculate some sort of interest expense, and then we'll label it. Okay, so it's interest expense, or interest rate, excuse me, interest rate. And I'm going to label that as RD, the rate of interest. Okay, and the way I'm going to compute the rate of interest is I'm just going to take the interest expense on the income statement. So I was going to take the interest expense that's on the income statement and divide it by my long-term debt. So we can come up with some reasonable estimate of what their effective interest expense was. So I'll divide it by long-term debt. Okay, now when I say long-term debt, I'm not just saying I'm going to divide it by the whole number of, just by long-term debt, but any long-term debt on the balance sheet. So if I had leases, if I had pensions, I would use that for long-term debt. Okay, so let's go ahead and go up to interest expense. Okay, and so let's go to interest expense on the income statement. We already know what it is, but I'll go up to all the way up there anyway. Okay, so interest expense is $79.70. My long-term debt, actually, in this example, I believe there are 2 items that should go into long-term debt. One is, it's going to be down here, it's past it. One is long-term debt, and I'm also going to include other non-current liabilities. Non-current liabilities of any type generally have an interest rate attached to them. So my long-term debt is that amount right there, total long-term liabilities. And it really, I could have just taken this number here, but it's nice to reiterate. Okay, so let's see. The interest rate that I'm going to use, the RD, the interest rate that I'm going to use in my calculations for working for weighted average cost of capital, is about 1.4%. Okay, and that number is just the interest expense divided by the long-term debt. Now, from an accounting perspective, that kind of makes sense, because if under GAAP, you know the effective interest approach, under GAAP, companies have to use the yield rate to compute interest expense on bonds and other types of long-term debt. So this kind of makes sense. Okay, now, weighted average cost of capital. Under the weighted average cost of capital, what we're going to do is we're going to take the interest expense for debt and the interest expense for equity, take their percentages, which, by the way, are right here, take those as percentages, and then we're going to weight each one. So what this means is that in this case, the cost of equity will be about 60% of our weighted average cost of capital, and the or 61%, and the cost of debt will be about 39%. Okay, so let's go down here and see where we can go from here. Okay, so the first thing I'm going to do is I've got my interest rate here, and I'm going to compute a variable now. I'm going to call it the return. This is the return on levered equity. And so I'm going to call this RL. Return on levered equity. Okay, and keep in mind that the RL contrasts with return on unlevered equity that I calculated up here. The return on levered equity should be more because, as we've said, I keep saying, stock in a business with debt is riskier than stock in a business without debt. Okay, so the return on levered equity should be higher than the return on unlevered equity. Okay, and I'm going to go ahead and just I'm going to list the variables going down, and then I'll go ahead and give you the equation on it. So the first number that's going to go into the return on levered equity is the return on unlevered equity, which is up above. We'll do that in a second. I was writing down the line items for this particular equation. Okay, then I'm going to have 1 minus the tax rate. That's 1 minus the tax rate. Okay, then I'm going to have my debt to equity ratio, which we've calculated. We've calculated all these numbers. I'm just going to point, and then I'm going to take the last part is a difference, and that difference is the return on unlevered equity minus the interest rate that we just calculated. So that's going to be that right there. Okay, so let's start with the return on unlevered equity. Okay, so the return on unlevered equity is the amount is equal to the return on unlevered equity, RU, right here. That is RU. Okay, so oops, gotta make sure I'm picking it up there. So this is equal to RU is the return on unlevered equity. What am I doing here? It is right there. Okay, so that's 12.2%. Okay, 1 minus the tax rate is 1 minus is equal to 1 minus the tax rate. Now the tax rate is right there. 1 minus tax rate, 78%. And you'll be able to see the formulas. 1 minus tax rate at 78%. Now the debt to equity ratio is very easy. All I'm going to do is take the percentage of debt that I calculated on my market value balance sheet in the previous video and divide it by equity right there. So that's going to give me, I think I'm getting a lot of decimal places here. Let's see what it's giving me. I'm not sure what this is giving me here. Why is it going out so long? 15 places, wow. How'd that come out? So we've got about 64% debt to equity ratio. Okay, and then finally, RU minus RD is the difference between, this is equal to the difference between the return on unlevered equity, and I'm going to take the number from up here to avoid any possible circular reasoning in Excel, and subtract that from that. I'm going to subtract my return on debt. Okay, so that gives me about 11%, just rounding up to about 10.8%. Okay, now my return on unlevered equity, and keep in mind, or excuse me, my return on levered equity should be higher than my return on unlevered equity, and you see it is because I'm going to sum some of these things, and my base number is the return on unlevered equity. Okay, which is the 12.2%, and then I'm going to add some things and multiply some things out. Okay, so the equation for the return on levered equity is as follows, and I'll write it out in text in a second. Is you take the return on unlevered equity and add to that 1 minus your tax rate, which is right there. Okay, and then I'm going to multiply 1 minus the tax rate. And I'm doing it right so far because I have parentheses right there. Okay, so I'm going to take 12.2% and add to that the product of 1 minus the tax rate times the debt to equity ratio times the RU minus RD. So times that number right there. Close the parentheses and see what we get. In this case, the return on levered equity is 17.608. And I'll just, these to be consistent, I'll take the percentage off because I want to compare it to the return on unlevered equity. Okay, I'm just going to make it a number here, 1.176. Okay, and compare the return on levered equity with the return on unlevered equity, and you find out that, of course, the return on levered equity is the same. Now, I'm going to go ahead and, just for your own convenience purposes, what I'm going to do is I'm going to sort of spell out this equation for you, just so you have it. Okay, the return on levered equity is equal to the return on unlevered equity plus 1 minus the tax rate times, this is all a product, the rest of this, times the debt to equity ratio times the difference between times the difference between the return on unlevered equity and the interest rate that I just calculated. So that's what that number is, and all the variables are right here. Now, what's interesting, and I would like you to know, this is more finance than anything else, but if you look at this equation, the debt to equity ratio is key in all this. And all I'm saying with the debt to equity ratio, and I'm just going to change this very quickly and then change it back, but you'll notice that if you have zero debt, your debt to equity ratio would be 0. So if you have zero debt, your return on levered equity would be the same as the return on unlevered equity. And so the more debt you have, the higher your return on levered equity goes beyond your return on unlevered equity. So just keep that theoretically in mind. The whole return on levered equity really comes down to that debt to equity ratio. If you have zero debt, then unlevered and levered equity are the same. The minute you start building up more debt, then the return on levered equity goes up, starts increasing. But I'll just go ahead and put in my original debt to equity ratio. That's an important theoretical point right there. Okay, now that we've got all these returns here, we're in a position to compute our weighted average cost of capital. Okay, so I'll just put, here's our Wacc calculation. And the first thing I'm going to do is I'm going to compute the weighted average cost of debt. We'll do that first, and then we'll compute the weighted average cost of equity, sum them, and that'll be our weighted average cost of capital. Okay, so our weighted average cost of debt, here is the formula for the weighted average cost of debt. Okay, and I'll do the same thing. I'll write the variables first and then place them in there. Okay, so the weighted average cost of debt, the first variable is the percentage of debt that you have, and that was right up on the market value balance sheet that I've been doing. The second variable is 1 minus the tax rate, and we know that's 78%. Okay, and then the final variable is the return on debt. So the product of these is going to be my weighted average cost of debt. Okay, so the first number here is the portion of your capital that consists of debt. That's it right there. Okay, and maybe I'll put, this is my variable name here is PD, and then my variable here is PE, let's call it. Okay, so those are just the amount, the proportion of your capital less debt and equity. Okay, the next number is my 1 minus my tax rate, which is equal to that number right there. I'm hoping that I don't get circular reasoning on that thing. Okay, otherwise I'll just change it manually. And then the final thing is my return on debt, which I have calculated. My return on debt, which I calculated going down here, which was is this number right here. That's your return on debt right there, RD. So maybe I'll just, that's RD. I already said that was RD. It's right there. Okay, there's your return on debt, your interest expense. Okay, so let's go ahead and multiply this, and this is weighted average cost of debt. Excuse me, weighted average cost of debt. Okay, and I'm going to go ahead and put the acronym in here. Weighted average cost of debt. So I'll put the acronym right in there. Okay, and it's just going to be the product of those three things. My 39, more or less 39% proportion of debt times, that should not be divided by that should be the product of, so it should be proportion of debt times 1 minus tax rate times my return on debt. So my weighted average cost of debt is about 0.43, 0.43% more or less. Okay, and I'm going to go ahead and move that number out there. Okay, so that's my weighted average cost of debt. Okay, so we're saying that that's not very much, but you're paying less than 1% on a weighted average for your debt. Your debt, they're charging you about 1.4%, but only 40% or 40% of your capital is equity. So on a weighted average basis, that comes to about 42 or 43%. Okay, the next one is the weighted average cost of equity. Okay, and let's put an acronym in there for now. Let's call it the weighted average cost of equity, WACE or something like that. Okay, and this is in a sense a much easier formula because it's just going to include two things. It's going to include the proportion of my capital structure, which is equity, which is going to be, by the way, this number right here. And it's going to, then I'm just going to multiply that times the return on levered equity, which makes sense because by definition, when you're doing the weighted average cost of capital, you wouldn't do it unless you had debt in there. Okay, so my proportion of equity is 61% more or less. My return on levered equity, RL, is 17%. That makes sense right there. And so my weighted average cost of equity is just the product of these two. So it's 61% times 17% more or less. So my weighted average cost of equity should be, it's point, I'm going to change this to point, I don't think it's going to change anything. I'm just getting a different number than I should. Let's see if, first of all, let's change the formatting. I'm going to change it to a number, 0.610. Okay, 0.610 times 0.76. That gives you a weighted average cost of equity of that amount right there. Okay, and so 61% times 17% gives you is equal to that amount times that amount will give you your weighted average cost of equity. That looks better, actually. Let me reformat this. For some reason or other, it was giving me a wrong number. It should be just under 10.5%. I know the example, so we will go out this and we'll stretch this out just. Okay, there it is right there. 10.74. That's exactly what I should be getting. Okay, so what we're saying is on a weighted average basis, my debt is costing me less than 1%, less than 1/2 of 1%. Okay, and I'm going to reweight this. I'm going to reweight this as a number. I'm going to reformat this as a number 2. Also, just to be clear. So, I mean, I'm hardly paying anything on debt, and I'm paying close to 11% on equity. So maybe you might want to shift a little bit to get more of a tax benefit on the weighted average cost of debt. But anyway, the sum of these two is your weighted average cost of capital. So this is your weighted average cost of capital. Okay, so I'm just going to take the weighted average cost of debt. So this is equal to the weighted average cost of debt plus the weighted average cost of equity. And you end up with, I don't know why it's giving you dollar signs, but you end up, I'll just do it as a number, you end up with 11.17% more or less. That corresponds exactly with my numbers, and it's a sum. All weighted averages by definition are sums. So that's the number right there, your weighted average cost of capital. Okay, and now we're going to go ahead and use the same numbers that we used before. We're going to it's going to be kind of a repetition of the calculation we did for the previous method, but let's start by calculating. Think about this. We're going to use a no-growth formula, and so all we need is a cash flow on top and a cash flow on the bottom. Okay, so I'm going to say that the following is value of the firm, which really is the value of assets. I'll say this. And keep in mind why it's the value of assets. It's the value of assets because we're going to have free cash flow to the firm on top. And keep in mind the free cash flow to the firm is all the cash flow that is produced by a firm's assets. And on the bottom, let me put it's going to be a ratio here. On the bottom, we're going to have our weighted average cost of capital. And in this equation, the denominator and numerator must match. So the free cash flow to the firm is the cash flow that's produced by all the firm's assets, which are equal to liabilities plus equity. And on the bottom, we have the weighted average cost of capital, which, as you have seen, includes both the cost of equity and the cost of debt and the cost of capital. So both the denominator and numerator here must include cash flows that match with assets. Here, and cash flows which match with assets, and a weighted average cost of capital, which by definition, weighted average corresponds with the returns required by both shareholders and creditors. Okay, so let's just go ahead. Your free cash flow to the firm, it seems like an eternity ago, back in video 2, but if we go up to the free cash flow to the firm here, the free cash flow to the firm is at 1633.82, and then we're going to divide that by our weighted average cost of capital, which is that number right there. So the value of the firm, the value of the firm's assets is equal to, should come out to 14, I think, 1633 divided by 11%, and it comes out to 14,629.05. Okay, so we're going to start our summation of the value of the firm with that. Okay, so we start with the value of the firm, the value of the firm's assets. Okay, and then we're going to add in, and keep in mind, I'll talk about the theory a little bit later on. Okay, but then I'm going to take the value of debt. Okay, we'll see what we get, and I believe that should be logically, I'm just going logically here, that should be a negative. So that should be a negative right there, minus the value of debt. And then just like I did above, I'm going to add I'm going to go ahead and add basically working capital. And I'm just, for working capital, I'm not taking, that's plus working capital. Okay, and so let's start with this. Okay, so the value of the firm is 14,629.05. Okay, now this is equal to minus the value of debt. The value of debt I've had a bunch of times here. It's 5 something. There's the value of debt right there. There's your long-term debt. Okay, plus my non-operating working capital, which is that number right there. Okay, so if I add those 3 numbers up, the 14,629 minus the 15,704 plus the working capital, let's see what we get. It's going to be that number plus that number plus that number. That is good. And that's going to give me the value of equity of a levered firm, value of equity. And that makes sense because we started with the value of the assets of a levered firm. Then we pull out the value of the debt and throw in the working capital. You know, theoretically you should be throwing in maybe some liabilities there too, but liabilities like accounts payable are generally operating things. This working capital I threw in, which equals cash plus short-term investments, and the number was from up here. Excuse me, the number was from up there. Those are things that the company it's just cash management basically. So I get value of equity is equal to 12,578,000,000, and I want you to realize, should come to this, realize that it's the same value I got up here using the adjusted present value approach. Okay, it's just not round. No, it's the same value. Okay, so if I divide by the number of shares, and I'll just make the number of shares equal to the same shares that I had up here. I'm pretty sure this is pretty much close to the number of shares, 1078. Let's get that, do a better job of formatting this thing. So currency number is going to be, I think it was 1079, doesn't really matter. Okay, 1079, and I'll put in shares there. Shares. So under the weighted average cost average cost of capital approach, I'm going to get a value per share equal to the value of equity. So I'm going to sort of bold this, I guess, equal to the value of equity divided by number of shares, and that is equal to value of equity divided by the number of shares, and it gives me $11.66. And I'm going to point out that this value I got here, this $11.66, we'll do that, is equal to the same value I got using the adjusted present value approach. Now you may once again be asking, you have 2 different approaches. You get the same result, so why don't you just use one over there? I think they complement each other. The adjusted present value approach is really emphasizing the theory that if you take the value of an unlevered firm and add the value of the tax shield, that'll give you the value of the operating assets of a non-levered firm. Which is really the theory that we've been talking about here, is that all firms are the same, regardless, all firms are valued based on their assets, regardless of whether they're common stock, finance common stock, or both common stock and debt. And the only difference is the value of the tax shield, in a sense. So in a way, the adjusted present value approach emphasizes this perspective. The weighted average cost of capital approach emphasizes you get the same number, but it places more emphasis, in my opinion, on really looking at the debt structure of the firm. So if you're doing a leveraged buyout, let's say, so this would probably be a better way to get the to look at the value of the firm that is going to have the combined firm, which is going to have a lot of debt after it's been bought out. Okay, so you get the same result. Okay, and so this concludes the third video. I told you it would be short. Okay, I hope it's been short. And in the final video, what we're going to do is we're going to and I'll just put up the title here. In the final video, in the fourth video, we're going to we'll call this number 2. This is value of firm with 20% growth. Okay, and that'll be the final video. I'm just starting it now. But if you look at this, we've got 2 sections, valuations. First one I have is no growth valuation, and I did that using 2 approaches, the adjusted present value and the weighted average cost of capital approach. Got the same result in both cases, $11.66. And now when we add growth, we're going to see how much 20% growth adds to the value of the firm. Okay, so let me go ahead and sign off here. Stay well, which you'll be hearing from me in a few minutes because I'm going to upload this video and then get right straight into the next one after probably taking a walk here. Okay, so you'll be hearing me for a minute. It's about a half hour, so for me that's a short video. Okay, so long for a few minutes. Bye-bye.